All right, testing 1, 2, testing, testing. Hello, anybody out there? All right, we'll give it a minute before people can hear me. There's some kind of what do you call it? What is this bullshit? Chrome is like popping up ads or something or articles. Really annoying. You are kidding me. Stop it. Do you hear this? Oh, come on. Oh, that's bullshit. That was like 6 or 7 different ads that popped up, or they were articles, and I'm sure they were, sponsored bullshit. Ugh. I'm telling you, man, they're ruining the internet. You know, it's when you search for something, it's pointless. You think you can ask it a question, like the idea of the internet is you're supposed to be able to find something out, right? So if I say pizza, oh, if I take the cap lock off, if I say pizza, Delray Beach, Domino's, come on. First, I guess we do have a Domino's somewhere, but I mean, for God's sakes, Pizza Hut. It's not about like what's actually in town because Domino's gets all this space. There's ad right there, ad for pizza and pizza also. Then you get back to this, but then Domino's still comes up early because they still pay the money. It's bullshit. And obviously Anthony's pays because look at Anthony's ranking. Anthony's coal-fired pizza. Then you've got TripAdvisor and Yelp, not actual pizza places. You have the conglomerating sites that, oh, you guys can't see this yet. I don't have the screen on, but nobody's even saying they can hear anything. So who the hell knows if anybody's listening? So I'm just bitching and complaining, and I will do so until people say they can hear me bitching and complaining. Then we can move on and start doing some actual work. But until then, I will bitch and complain. But anyway, so I'm Googling, because you can't see it yet. I'm Googling pizzas in Delray Beach, and it brings up advertisements. And then it brings up the conglomerating site like Yelp and like TripAdvisor, and it's still not telling me what I wanted to know. I want to know what pizza places are in Delray Beach. I don't want to hear about the 10 best pizza places. I mean, it's useful if it's real, but who knows if it's real? It's just some bullshit that Yelp decided. Anyway, can anybody hear this at all? Is anybody at all out there listening, or am I just talking to the wall? There you go. Corey says, no, yeah, Corey and Neil can hear me bitching. All right, so let's get the screen going and see if that works. Then you can see me bitching and complaining. No, but this is pissing me off. All right, and I'm going to be 60 in 2 years, not 2, or actually a year from March, which is close, and I am getting pissed off. At this stage of my life, I am not happy. So this has been a lately problem for me, though, is I've decided the internet is broken. The concept of the internet is broken. It doesn't do what it's supposed to do. It's supposed to be a source of information. Good luck trying to find it. And of course, I use it all the time, looking for information, trying to find things. And it is ridiculous how much paywall stuff, how much advertising, ad. So, there's no democracy to the internet anymore. It's really all about who pays the most for clicks, who pays for positioning, who has the best SEO, and who puts the best keywords in, and blah, blah, blah. And it's all to please the gods of the internet like Google and whoever. It's got nothing to do with giving people information, which is what it was freaking designed for. We've lost the reason the internet exists. The whole purpose of it was to make information freely available to everybody and to share information. And instead, it's just it's another frickin' it's the media takeover sort of thing, basically. Just it's annoying. I'm very annoyed. Anyway, on to And now I have a robot read you the disclosure. Hang on.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay. Seems like some updated Windows seems to have screwed up my settings. Or redefaulted them to Microsoft, which again, I thought they lost a court case about that. Because things have been redefaulted away from Google and what I've chosen as my preferences. But anyway, all right, enough of that. What are you going to do? Nothing you can do about it. That's just the way things go. Let's see, charts. There's the charts. And is that where we are? Now let's look at those are stuck. So let's look at these futures. Here you go. These charts. So basically, up 400, up 47. So basically, we're up 1% in the indexes. The rest are a little bit more excited if we flip to the daily view. But what matters is, though, this is kind of a point where you ignore it, but 4550 to 4300 is 250 points, and that means your bounces should be 50 points. So 4350 is a weak bounce, and 4400 is a strong bounce. So here's where we start paying attention at the strong bounce line. For the Dow, 35.5, and then you go into 33.5, so that's 2,000 points. That means you have 400-point bounces, so it's 33.9 and then 34.3. So the Dow is also just under the strong bounce, and the S&P is just under the strong bounce, and that's what we're looking for, is those lines in. And it's already Wednesday, so hopefully by tomorrow, well, not really hopefully, because frankly I'd like to see it go down a bit further, but hopefully by tomorrow, if they want to be bullish, then they're going to have to get back over the strong bounce lines. And certainly 4,400 on the S&P is something to pay attention to. So that's what we're looking for now. And the dollar, meanwhile, is still up there. So if the dollar pulls back, based on the Fed, in fact, in an hour, the dollar could pull back, and that's going to give everything a boost back over the strong bounce lines. And that's probably what the game plan is for everybody, and that's why you're seeing people running in and trying to get ahead of this thing. Look at Brent. Brent's way back up here at 76. We're lagging in oil, so we might get a nice good entry again. I wouldn't jump into this or short it, because last time Brent was up here, okay, was early August, and we were at 74. Oh, what was the oil report today? I didn't even see it. Let's take a look. Look at that, lost interest in the oil report. That's how silly this has gotten. La, 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 la. September 17th is the correct one, I guess. Seems like so long ago. What was the 17th? That was Friday. All right, well, it's as good as it's going to get. Can't be the 24th, right? That's this Friday, so it's going to be from the 17th. So now we don't have the weekend captured. That's kind of weird. So imports, blah, 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 blah. Here you go. Oil inventories decreased 3.5 million barrels. Blah, blah, blah. Gasoline increased 3.5 million barrels. So those two cancel each other out, and they're bullshit. And distillate fuel decreased by 2.6. So on the whole, we have a 2.6 million barrel draw overall, which you would think is disappointing. I'm disappointed. Still, we're going up 2.5% gain in the price of oil. Let's see on the daily chart. I wouldn't really attribute it to the report, right? I mean, here's 10 o'clock. Well, so okay, so from 10:30 went from 71.40 to 72, but this is bullshit. There's no reason for this. And based on the fact that Brent is so high, I would just stay away from being too long. But that's probably being caused by the gas shortage in England. Is the natural gas is a tremendous shortage in Europe of natural gas, and that's causing all kinds of problems. So it's probably driving oil prices up too. Excuse me, I'm drinking out of I have a giant bottle of tea, which I usually pour into a glass or something like that, but I just grabbed it because it's near the end. But it makes bubbly noises when you drink it. I didn't know that. Because I'm a civilized person who doesn't usually drink straight out of the giant bottle. Anyhow, all right, enough of that. So, oil, right. So, not a very big draw. And now let's go back to the thing I blotty-blot over. That's a Seinfeld thing. Over the past 4 weeks, oil import averaged 6.1 million barrels a day. Not that. Averaging 9.6 previous week. What was I looking for? Commercial 3.5, 8% below the 5-year average for this time of year. All right, so that's a big thing. We're 8% below the 5-year average for oil inventories. Gasoline inventories are 3% below the 5-year average, and distillate fuels are 14% below the 5-year average. So, interestingly, mostly because of the hurricanes and some other crap that's happened and the shipping delays that are going on all over the world, and our lack of production. Also, we've had a lot of production shutdowns. We are dwindling in our total inventory, and we're quite a bit below the historical norms. That means we're very, very subject to price shocks because we have a lower than usual supply. Not that it matters, because we have 1.8 billion gallons of oil in storage. Here's what we had last year. Last year we had 2 billion gallons of oil, so we have about roughly 200 million less barrels of oil, which is a 10-day supply less oil than we usually have. Now, how many days supply do we have? Well, it's 180 divided by 20. So 180 divided by 20 is what, 9? So, wait, is that right? That doesn't sound right. No. I'm sorry, it's 1800, it's 90. That would be terrible, 9. So it's 90, we usually have a 90-day supply of oil, and that's not the way to look at it anyway, though, because realistically we make domestically 10 million barrels a day. So we only need to import or supplement 10 million barrels a day at worst, but then we have most of the other oil comes from Canada and Mexico, and very little from overseas, really. And that means so that means that we don't have a very big dependence on imported oil. So it would have to be something horrifyingly catastrophic. So we have 90 days of oil, of our total consumption of oil, sitting in the ground, and we have what did I say, 10 days. We have 10 days less than usual. So usually we have 100 days worth of oil. Now we have 90 days worth of oil. That's what matters. But when you have 90 days worth of oil, if something indicates that you're going to have 80 days worth of oil, people start making a lot out of it. And that can keep prices a lot higher than you would think. And you know, don't forget, this market is any excuse to drive oil prices higher, they're going to do it. So notice product supplied is down a bit. Last year we were supplying much less product. Now we're supplying much more product. So and since we're not having a net build, you have to assume consumption is up, right? We are not exporting more. Last year we exported 2.7 and here 2.3. But what are we comping though? We're comping last September. Last September we were all sitting in our house. Nobody was going anywhere doing anything. So you know, so the drawdown is from last September, and the consumption is up from last September. So this is just sort of a adjustment period coming out of the lockdowns, and things will normalize eventually. There's nothing, there's no imbalance to supply and demand. It's just a normalization. It's like when you know. It's like you have a faucet, right? In your sink, and your sink, you want water. You turn on the faucet. You turn on the faucet, nothing comes out for a minute or for a second or whatever. You turn on the faucet, takes a second, then water starts coming out, and then too much comes out, and you turn it back down, and eventually you pick the right amount that you want it to be. You know, so the sink's not wet enough, then it's too wet, then you make it not wet enough, and then you say, okay, well, maybe in between, and you adjust it, and then finally you say, okay, time to brush my teeth. You know, if you think about it, you make a lot of little micro adjustments along the way. That's what it is. When you restart something, you're not necessarily going to be operating at maximum efficiency, and adjustments will come back and forth. There'll be a flow back and forth of too much oil, too little oil, so on and so forth, until they find the right balance again. So that's where we are right now. In that case, though, you don't, you know, when you're, as I said, when you're brushing your teeth, you don't go, oh my God, we don't have enough water. You know, it's going to work out. You know, we don't have enough hot water, we don't have enough cold water. Right? It's not like that. It'll be fixed. It'll be adjusted. There is water. People will adjust it. In this case, there is oil. There are distillates. There is petroleum. They just don't know the mix anymore. And so we have to do different things than we've done before. So that's where we are on this. Anyway, so there's not much going on here. It's not very exciting, but it's tight enough where you can have supply shocks. I'm sorry, demand shocks, and OPEC is being smart. They're very, very gradually putting more oil on the market, but not in a way that's going to change anything drastically. As you can see, oil this week is more than it was last week at 72. Last year it was 41. Crazy. You should have just bought it all last year, right? That's what futures are for. Gasoline. See, it's interesting because oil's gone up quite a bit, but gasoline's lagging by a lot. Obviously, gasoline only went up 50%. Oil went up whatever, about 75%. And does that make sense? What doesn't make sense is the price of oil, because gasoline is demand driven, and people will stop using it at a certain price. So people won't pay more for the gas, but they will pay more for oil because that's manipulated. So that's where we stand on that market. So Neil says, Eater is my go-to for learning about where to eat in a place. Everything else is exactly what you're talking about. Yelpers suck. Yeah, Eater I read. Is that the one I like though? Something. There's something like a foodie thing. I don't think it's Eater. I think there's something else which is a foodie thing that I like, that I kind of listen to. But yeah, I mean, honestly, when I read Yelp, I can tell from the reviews who knows what they're talking about. Like I'll look at people sometimes, and I'll like read the review, and from the way they write the review, some people actually, you know, understand what food is, and some people have no clue. You know, And I'll look at other reviews they've written about restaurants I might know if they're from the area, and see what they think about, see what they say about those. But I was saying that a friend of mine, actually, I was saying, you know, because we were in a restaurant we were eating, and it was recommended in Yelp, and it wasn't very good. And I said to my friend, I'm like, well, the problem is we don't write a review. You know, this is what the problem is the people who are qualified to write a review don't write a review. It's just random jackasses writing reviews, which is frankly Seeking Alpha's business model. I mean, that's the same problem in financial information, right? Is when you go to Motley Fool or you go to Seeking Alpha or whatever, it's random people, but you can do the same thing. You can also look and see what these people know. So, you know, when you read an article, here, 3 reasons you should own Microsoft and buy these other things, blah, 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 you know, written by Dividend Kings and Dividend Sensei. So you got to look and see what the hell this guy is. Does he know anything? You know, do you agree with other stuff he says? No brain at blue chips. This guy's a click jockey. You can tell when people have numbers in their things, that's like a clickbait thing. 4 reasons Walgreens is set to sell 2 yield traps. AT&T is set to soar. All right. We have AT&T. So now I agree with the guy. I'm looking for things that are factual here. There's really nothing. It's just very vague sort of things to attract your clicks. Blah, blah, blah. Omnicom. Really? Oh, well. Anyway, so you kind of try to figure out if these guys know what they're talking about or if they have any idea. He's got a lot of followers, 85,000. I only have 65,000. So somebody listens to this guy, or again, but it's clickbait. I have 65,000. I don't write. You want to see what mine is? See if I can find my profile. Here's my profile. So I have 66,000 followers. But here's how often I write articles. Here's September. Here's May. It's May of last year, not May of this year. May of last year. May, April, blah blah blah. So I haven't written on the site in basically a year. I wrote this one thing on September 1st. Yeah, because my followers went down. That's why I was like, I guess I should write something so people remember I'm here. You know, but I just got tired of this nonsense with Seeking Alpha. I got tired of being treated like one of these people. You know, it's just it insults me, frankly. It just really does. There's a lot of crap. I mean, and you know, look, there's plenty of good analysis on Seeking Alpha, but you know, there's also plenty of bad stuff, and nobody can tell the difference. So, but anyway, not to pick on Seeking Alpha because Motley Fool is even worse. And there's a thing called Tip Ranks. I like Tip Ranks is fun because you can see the analysts and see if they know what they're talking about, or you know, they kind of get their track record. What is this doing? It's not. Click on Analyst. Oh, it's telling me Analyst for Tesla, I guess. Unknown analyst, not yet ranked. Ooh, let's go. Let's follow him. Look at this guy. No stars, no stars, no stars, no stars. 47%, 46%, 29%. 29%. This guy can be beaten by a coin. Like a broken clock is right more often than this guy is. Average return minus 50%. Ooh. Anyway, so Tip Ranks is fun though because you put in the name of a stock. So you say Apple, and what? App Loving Forecast. What? Oh, I hit enter too early. APL. Apple. Yes, that one. So here's Apple, and Tip Ranks is fun because it tells you stuff. Stop this. Why? Can I continue with Google? Yeah. I'm so annoyed. Anyway, so you get an idea of like what the analysts are doing. Here's the high, the low, the average. And again, not that these people have any idea what they're doing. Oh, you are pissing me off. Anyway, so not that these people know what they're doing, but at least you can get an idea of who's doing it, and you can get a whole information from them. So here's Laura Martin, 60%, Rod Hall, 50-50, David Vogt. Oh, look at this guy from UBS, 73%. Jim Suva, 60%. Sami Shakilba, 63%. Very good. Okay, so these are better analysts, obviously. I don't know how this guy got in here. Can you believe he's 50% and three? He's Goldman Sachs too. He's 50-50 in his picks. 97 out of 200 of his picks were successful, and he gets 3 stars for that. That's a 3-star guy. His average return is 2%. So who do we love here? Who's the superstar? David Vogt of UPS. He only picked. See, this is what I tell you guys all the time. He only picked 15 things, and he got 11 right. He's smart, and he's 18% successful. So that's a guy you listen to. Unfortunately, he doesn't speak a lot. This is a problem investors have, though. You'd rather get a pick than get a good pick. You know, this happens all the time. Like if I don't make picks, people get upset, especially top trade people. They're like, why are there no top trades? Well, there's nothing I thought was good enough for a top trade. That's why there's no top trades. When I think something's good enough for a top trade, I make a top trade. If there's not something good enough for a top trade, I don't make a top trade. I'm not going to do it just because I didn't do one since last month. That's not how you be correct. David understands this. Okay, this guy's got 344 picks. This guy's got 135 picks. This guy's 200 picks. Laura's got 400 picks. Holy crap. But David, now the most successful guy, makes the least picks because he picks the right thing. You know, Warren Buffett too. Warren Buffett's portfolio, he's got 20-something stocks in his whole portfolio. He's got a lot. He buys big chunks of a lot of stocks, but he doesn't have 50 stocks, 100 stocks in his portfolio. He's got $180 billion invested in 20 stocks. He doesn't need to have, he's not going to sit there and diversify. That's not the answer. And it's the same with our portfolios. I say this all the time. You really should take your total account and basically divide it by 20, assuming if you have 100,000 or 50,000 or whatever, then divide it by 10. Have less picks, not more. All right. But if you have a couple 100,000, 500,000, million, divide it by 20. You should have basically double your cash should be your buying power. You take your buying power. So if you have $500,000, you have $1 million in buying power. You divide it by 20, and that's $50,000, and that becomes your allocation block. And that means your position size should be $50,000. And that means what you should do is your goal for a position should be to fit into a $50,000 allocation block. It also means you start off with a 1/4 allocation block. And that's our whole strategy section where it says scaling in. We talk about strategy here in the PSW strategy section. And we say, see the article on scaling in. Okay. So it's really, really critical. Okay, this is and we talk about it here, entering a position, contracts, blah, blah, blah. Okay, you've got to come in lightly and begin with a smaller position. And frankly, that's what we do when we sell puts. So if you go to the, when we have an empty portfolio, what do? We start off by selling puts. And here we sold, here's ones from this month, C913. So we got Vail, we sold some puts. So Vail is a $15 stock. We sold 20 puts. So we say we'll buy 2,000 shares at $15, and we got paid $3 for it. So we're going to buy 2,000 shares. So that's what we offered for Vail. And so obviously gotten worse since then. Look, it's down a lot. So it's what happened to Vail? Let's see. We only just bought that. Wow. So they got down to 18, and we thought that was going to hold, and we took a hell of a tumble since then. Because this is from the 13th, we did it somewhere around here. But we were happy with 17. 17 seemed like a reasonable net price. Oh wait, not 17. Is that right? We sold the $15 puts. Oh, I'm sorry. We sold the $15 puts for 3. Oh, that's silly. It's even sillier now. Okay, so that's why we sold the $15 puts for 3. That's net 12. And the stock was at 18 when we did it. Where? Oh, yes, that was it. So the stock was at 18. We sold the $15 puts. That was me calling the bottom. I said 15, 15. I said, I'll buy it for 15 based on the valuation, right? We did a valuation thing. We said, well, 15 is definitely where I jump in. And apparently I'm not the only one who does my calculations that way. So somebody else very big jumped in. Look at the massive candle, right? So this candle, or I'm sorry, this volume got supported very quickly at 15. So somebody was totally happy to buy whatever they wanted to throw at them at 15. They stopped the wave and reversed it. So now we'll settle out. We don't care what it is as long as it's over 15. We're going to get our $3. But that's how we enter a position. And so if you think about it, and I don't go crazy with the allocation blocks. Basically, in the long-term portfolio, generally $100,000 is an allocation block. Okay, so we will ultimately have 20 $100,000 positions for $2 million. But again, that would be double the $1 million that we're counting on having in the portfolio. We actually have $2 million at the moment, but I'm not going to sit there and it wouldn't be tradable for most people if we did allocation blocks like that. So I'm keeping it at $1 million of buying power, sort of size positions, and most people have $500,000 that they're trading with, so that should fit. But anyway, so Vail, we just take a stab at it. But the point is, it was a very small entry. We don't care. We didn't know if it was going to be the bottom or not. And in fact, frankly, we hope it isn't, because then we could add a bull call spread or do something else. But we're not, given the conditions they are now, we're not jumping right into it. But net 12, very comfortable entry, and it's only going to cost $24,000 for our first position. That is a 1/4 of $100,000 allocation block. So that's all we've initially allocated to the position. Or worst cases, we end up with a 1/4 position on Vail. So if it goes to 6, we're happy to double down. In fact, if we double down at 6 and buy 22,000 more, that's only $12,000 more dollars. And then we would have spent $36,000, and we've got 4,000 shares of Vail. So, and given that we think Vail is worth at least 12, there's no downside to that. Owning the company that you want to own is not a downside, right? Owning more of the company that you want to own for a lower price is not a downside. But that only works if you're a fundamental investor. If as I feel, Vail is a real company that has a real value. If on the other hand, I go chasing after some high-flying tech stock that's all a bunch of promises, and they drop 50% because their promises didn't work out, or biotech stock or things like that, and the promise and the bullshit that they claim never happened, then I'm not happy to double down when it goes lower. But when I buy blue chip companies, when I buy big companies that have been in business for many years and have a real business and do real operations, I'm probably not going to get burned that way. And not always. I mean, things happen. Sears went bankrupt. No, actually, not. I think they're done for, right? They're not even in existence anymore. So and big companies go bust. That does happen. But if you're sensible about your picks, and if you buy things that have strong fundamentals, and you plan, or you buy, you wanted to buy stocks that you're happy to buy more of if they go lower. Here's Apple. So we sold 10 Apple puts at 105. That's $105,000. That's a big chunk, but it's freaking Apple. So we're not scared of owning Apple and making it a big part of our portfolio. So 10 short puts obligates us for $105,000 entry, less 7 is $98,000. So if it's assigned to us, we get it at $98,000. Apple's at freaking 145. If Apple is at $98,000, I will be very happy to make it 10%, 20% of my portfolio. If you tell me, do I want to own 2,000 shares of Apple at $98? Of course I do, but that's not even what would happen because 98 only puts us even. We don't have a loss at 98. That's our break even on this trade. Is 1/3 less than Apple is now, or lower than that actually. Whatever it works out to, 40, whatever percent off. 30, 35, 40% off anyway. So Apple drops tremendously to 98. And what happens? We're even. So I'm getting paid $7,000 where my worst case is owning 1,000 shares of Apple at $98. That's my worst possible thing that can happen to me. And I'm being paid $7,000 for that. Now, then what's my catastrophe? Well, Apple goes to, from 98, Apple goes to 50. Drops another 50%. And we are stunned and amazed that this happened, right? It's like, oh my God, what the hell? Life as we know it comes to an end. Tech as we know it is changed forever because Apple is now 2/3 off the current price. I couldn't even tell you what catastrophe would be befalling the world for Apple to go 2/3 off the current price. But let's say that happens, all right? What do I do? Well, I still have two choices. If it's at 50 and I'm at 98 for my entry, I could take a $50,000 loss and walk away. That is my maximum risk. If I believe Apple has turned into a dud and it's down at $50, I've got to be prepared to say, okay, I give up. I'm walking out. I'm going to take my $50,000 loss and deal with it. How much is $50,000 going to hurt me on a $1 million portfolio? It's going to hurt me by 5%. I can risk 5% of my portfolio on buying Apple at a tremendous discount. Now, more likely, if for some stupid reason the whole market collapses and blah, 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 and Apple is at that level, and Apple, by the way, just sold their 2 billionth iPhone. So if Apple is at that level, and think about it, it's 2 billion iPhones at 1,000 each. So like $2 trillion worth of iPhones. And that's just one of their products, although it's the biggest product. Anyway, so Apple at 50. Now, what do I do? So my choice at 50, if I'm looking at Apple, if the market just crashed for some stupid reason, I buy 100 more for 50. Instead of taking a $50,000 loss, if I spend $50,000, now I have 2,000 shares of Apple, and my average is 98 plus 50 is 148 divided by 2 is 74 bucks. So what I'm really saying here is, do I want to own 2,000 shares of Apple at $74 a share, 50% off the current price? That's my bet. And if I really want that, because that's my worst nightmare, is either take a $50,000 loss or own 2,000 shares for 72 bucks or whatever I said, 74 bucks. Then this trade's a no-brainer, right? Then selling the puts and collecting 7,000 now is a no-brainer. I have no downside. I have no downside that I'm scared of. I have no downside that's going to bother me. I have the opportunity to own 2,000 shares of Apple for $74. Yes, please. How do I get that? What can I do to ensure the global economy collapses so that I can get my 2,000 shares of Apple for 74 bucks? And that's, by the way, exactly what happened to us in 2008. We loaded up the truck on Apple. One of the reasons our portfolios were so successful is Apple was a major part of our portfolios in 2008 because as it went down, I was like, son of a bitch, let's buy Apple. If there was any one company we thought was going to recover, it was Apple. And so as it got ridiculously cheap, probably $5 in today's prices, because they did a 7-for-1 split, maybe $10. It probably went down to 10. Yeah, I think they were like 70 at the time. So then they split 7-for-1. So let's say Apple was $10 in the current pricing. And don't forget that this Apple at 145, it's after a 7-for-1 split. So they're well over $1,000 stock on the old prices. So when Apple hit whatever they hit, we were like, why would you not buy this? And that was true of a lot of stuff. I mean, there were plenty of stocks we bought, but we had put in 2008, 2009, we had Apple in every single portfolio we had. And coming out of the crisis, our first stock of the year ever was actually Bank of America. Because I was like, there's no way the government's going to let Bank of America crash. They're not going to let it go bankrupt. So we took Bank of America when they were trading like $2, some ridiculous number like that. We went in with Bank of America as our first stock of the year. But after Bank of America, it was Apple for 3 straight years. Apple was our stock of the year because it was so slow to recover. And we just couldn't believe how cheap it was for year after year after year. It was just so ridiculous, but so ridiculously cheap. It ended up being our stock of the year for 3 straight years. And frankly, it would have been our stock of the year for the 4th year too, but I just got sick of picking Apple. I was just like, okay, everybody gets it. We love Apple. And everyone was successful, of course. So it went up, but it just went up in a slow, steady manner. Lately, Apple kind of took off, and now it's pretty fully valued. Which is why they keep hovering around this level. It's hard for them to get over this level. They're above $2 trillion in market cap at this point. Anyway, puts. And the other one was yeah, I forgot we put those guys in. So we just put in AWW. And the same kind of thing, though. So we took the November 65 puts. They're at 74. So we're a lot more aggressive here than we are with Apple, because we think we think these guys are way underpriced. And again, we got 60, we did 10, we collect $6,400. And our worst case scenario is 65 minus 640, which is what, 5860, something like that. So our worst case scenario is only 1,000 for 5860. And again, in that case, it would be 1/2 of what we expect to be an allocation block. But if they seriously crash and get much cheaper, we're happy to own more. And look, we don't, and we're not. This happens a lot, by the way. We're not picking the dead bottom. We don't wait. We just sort of say, okay, it's a good time to get it. So I guess it was a couple of days. It was last week. So last week we decided that 75 was probably a good spot to get in, and we were worried it was consolidating for a move up, but instead it took a little dip early this week. But everything took a dip, by the way, this week. So big deal. And now it's a little cheaper than where we came in. But we like them. We think they're undervalued, and we think they're going to go much higher. But meanwhile, all they have to do is just not go lower, and we're going to be in good shape. And that's what you'll find when we go down, like Vail. When we lose money on a position, on a put position, it's more likely, because we're fundamentalists, because we're buying these stocks for fundamental reasons. It's more likely when we see a put that's down like that we're going to add a bull call spread than abandon the position. And like I said, I would have added a bull call spread on Vail when it did this, except for 2 things. First of all, I wasn't paying attention. Okay, number one. Number 2, but even now looking at it, okay, it's a matter of saying, are we in the mood to add bull call spreads? Do we want to throw more money in? No, we're just taking pokes at things with these short puts. You don't have to act on every single thing that happens. So we're watching and waiting. This is a freaking 2 years. This is an 18-month spread here. And we can now sell the 2024s, in fact, probably Vail. And that's another cool thing about put selling. Oh, that's not working. Shit. I'm shutting this down. For whatever reason, it's not working. Anyway, so there's 2024s are out now. And we could then roll to 2024. We can do all sorts of things. So, and that's the other thing, by the way, when we talk about selling the puts, it's not even fixed in time, because when you go further out in time, Yahoo. Heck. Is that the best we got on Yahoo? Well, let's do Vail. So Vail options, although Yahoo has shitty option chains, but Okay, so Vail, we currently have the $15 puts of 2023 and they're 430. And in 2024, the $13 puts of 430. Actually, they're, well, bid ask 450, whatever. So they're about 430 or $4. So basically, we could roll these $2 lower in 1 year. So our worst case scenario isn't even our worst case scenario, because we also get a free roll to a $2 lower strike that buys us another year of time. And that's another thing to consider when you're selling these puts, is that these aren't fixed costs. You know, we can actually buy time and roll further. Meanwhile, these are 100% premium, because Vail is higher than the strike. So this is 100% premium. It will expire over time. So there's no reason for us to do anything here. Just because we're down 43% doesn't mean anything. It's pointless. It's all premium. It's a made up number. None of it is a real value. And the other point about it is, yeah, we really would like to own Vail for $12. So come on, bring it on. So when we talk about scaling in, step one to scaling in is very often for us to sell some puts. You know, here's one that's working out, Frontline. We sold the $5 puts at Frontline. It's at $8. Those $5 puts are still 88 cents. That's crazy. So that's a 412 net entry even now, if you sell those puts for 88 cents. We sold them for $1.30. We have a 370 net entry on Frontline. So I said, yeah, we'll buy 5,000 shares of that. It's only 15,000, whatever, 18 something thousand dollars. So in other words, yeah, we'll buy $18,000 worth of Frontline. Got no problem with that. And if it goes, and now Frontline happens to be a company that could conceivably go bankrupt. So we are not $50,000, $100,000 deep into it, but for $15,000, $18,000, yeah, absolutely wouldn't mind owning it. And if we lose the money, we lose the money. It's not about what you lose on the position; it's about what you lose in the portfolio, and whether the individual risk is worth taking. So what this represents is us saying we would like to own Barclays, we would like to own Chimera, we'd like to own and who the hell's Enva? Forgot the name of this. ENVA. Enova. All right, so we decided we'd like to own Enova. Frontline, KBH Homes, the biotech ETF, Mitsubishi, Micron, Pets. We already have that somewhere, or we had it, and I think we just pushed it back in. Vail and Yeti, the cooler people. Oh, look, Yeti's doing good again. See now, Yeti. Yeah. See, when we first went into Yeti, people were worried about it, and it's already coming back. Oh, it's not actually even coming back that much. It just calmed down. And oh, that's what I mean about it not being real value. So in other words, Yeti, we only came in July 9th. And when we first came in, let's see, July 9th is down here. Anyway, so it was at 90 on July 9th. It went down at first. Okay, people are like, oh my God, I can't believe we went into Yeti. And I was like, you know, relax. It's a value play. Values come and go. People's opinion of value comes and goes. But the reality plays out over time. So now they're here, and because they stopped going down, the premium squeezed out of this thing a little bit. We sold the premium, which puts us in a good position. So already we're up 26%. I mean, that's crazy when you think about it. This is a 2023 sale that we made 2 months ago, and it's already up 26%. But why? Because we sold premium to idiots. Premium is a complete waste of money. Do not buy premium. It's guaranteed to expire worthless, okay? It's like buying bread that you have no intention of eating. It's going to get moldy. You can't keep it forever. It will get moldy, okay? It will become inedible and worthless. So that's what happens to all premium. It expires worthless. So we sell it. We don't buy it, we sell it. And when we do buy it, as in when we buy a put and we pay a premium on the put, we offset it by selling another put that has more premium. So our net premium is zero in these cases. This Wayfair is doing good for us. We don't want it to go too low because these puts are going to go on the money. This is January 240 on Wayfair. That's a good call, by the way. We sold these 240 puts in February. Okay, that was our prediction was 240 in February for this year, and where'd it go? And where did we bottom out? 240. All right, that's how you make a value call. Okay, that's the correct way to value a company. Look at the volume of people that came in at 240. So my calculation agrees with a very large number of people here who have computer algorithms that came on at the 240 line and offset the trend. So came a little sooner than I thought, but I still think we're going to settle down here. I still think we're going to settle down in the 240 range. But either way, we don't want it to go too low because 240 is our sweet spot. Because if this expires worthless at 240, what do? We sell. Well, frankly, I mean, frankly, 240 though, I might be happy with the price because we're going to get $100 here at least. We're at 103 now, so we'll get $100 here, and these will expire worthless, and we'll end up collecting $50,000, and it's a spread that we spent $40,000 for. But there's some offsetting. There's some other short call sales and things that we already made money on. So we're going to max out our spread. We could sell the we could sell instead of collecting the net $50,000 here, we could instead I think this might be the second time we sold. No, it's the first time we sold something. So we could sell the 2023 something puts and do it that way. But honestly, it's like I think we're done with it. My premise on Wayfair was basically where it is. I still think they're going to go down from here, but I don't know if I want to keep playing it. Anyway, so not to get all into every single position and whatever, but point being, it's this is what the long-term portfolio looks like. And this was a small position, obviously. We have a couple of stocks, not too many actual stock holdings. And then we've got 25 custom spreads. But you notice there's nothing too huge here. Well, you can see from the numbers on this side. Generally, nothing is more than $50,000. These are all very small spreads. We cashed in the big spreads. Here's Lockheed Martin's one of our biggest. Plains American is big. It's an actual stock holding. But otherwise, that's what we have. We have 25 positions. There's generally no piece of any position that's more than $50,000. And of course, they're hedged out. So you got Alibaba here, $62,000, but that's minus 32 is net 30. So we only have $30,000 in this position. And here we have short puts on Alibaba that are not doing well because of this China thing that's been going on lately. But they're 2023, and again, that goes back to the same thing. What are we going to do with Alibaba? We're going to Yahoo, because 2024s are out. Oh. Now, again, though, we're not rushing to do anything with Alibaba because we don't know what's going on in China. So we're not rushing to do anything. But we sold, we have some long calls here. And those are down significantly because they're the January 200s in 2023. We thought it was going to bounce better than it has so far. And we've got the short puts for the same time. So we thought there'd be some sort of an uptick. And they were coming back for a bit, but then they've come right back down to where we came in around here, and they come back down to 150. But we really think that's going to work out, but not enough that we want to put more money into it yet. Because who knows what's going on in China? Until we have more information, we don't want to take a huge risk. All right, we're down into a significantly down position for us right now. Logically, we should be rolling the 200s down to the 150s. Oh yeah, oh sorry, it's 2024. So we currently have $16 in the 200s. And so what do we look at? We look at BABA, and we say for the calls, we look at 2024. And we say, okay, what $16 spread do we want to have for 2024? Well, we're currently at 150, and these calls are, the last price was 44. So 44 minus 16 is going to be like less than 30. So let's say this. So see the 200 to 26. So we could convert the calls we have now into 1-200 bull call spreads for 2024. So that gives us 2 years to get to $50 per unit. What did we originally spend on the 200s? We spent 45 initially on the 200s. Okay, so that's only going to really get our money back at $200. But instead of having a strike at 200, we get our money back at 200. Can we do better? So then I say, okay, what if we start at 150? Can we do the 150, 100? Well, 150, 100 is $24. So that would cost us more money. Wait, I'm sorry. No, it's not 64. That's the 110s. All right. So the 110, 160 spread is $24. All right, and we have 16. So it would cost us $8 more to be $50 lower. And we have to look at like how much are we willing to spend to have a better strike, and then you also have to say, well, what's the point? If there's no point, we originally spent 45 bucks on the spread. We spent 45 bucks on the longs. We can buy the spread. We spent 45 bucks on the longs, and maybe we bought back short calls already. I don't remember. But let's say we spent 45 on the longs, and now it cost us. It'll cost us $24 to be in the 110, 160 spread. That's an attractive spread, but it only really works if we're willing to double down. So if we move to that spread and spend +6, now we spend $51 on the first set that we have. Then we add another set at 24. So then 51 plus 24 is 55.75. Then it's 37.50. Then we're into the 110, 150 spread for 37.50, and we have 12.50 upside. So is that worth it? No, it's not. It's not that exciting, is it? So the point is, I wouldn't make an adjustment and I wouldn't change anything until I see something I really want to be in. Now, we already said the 150, 200 spread is only $14. So it's actually cheaper than the, no, wait. Yeah, no, 12. No, 20, wait. 44, $18. So it's 18. It's the same as we have now. The 150, 200 spread is 18. It's the same as we have now. So then the question is, if we do that one, we spend no extra money. That means we're in that spread for 45. Then we buy another set for 18. Then it's 45 plus 18 is 63 and 73, and divide that by 2 is 26.50. So now we're in that $50 spread for 26.50. So yes, I would love to be in a I'd love to be in a $50 spread for 26.50, but I don't know for sure that I'm happy with a $200 target. So I know for sure I'm happy with a 160 target, but I'm not happy with the return on the 160 target. I'm not sure I believe in the $200 target yet. I need to wait for China to tell me what's happening. I need to see more information out of China. So we wait. Don't make the trade. Don't change anything. Don't adjust anything until you have enough information to make a good decision. The lower roll is not very attractive. I have to put in a substantial amount of additional money. I can't do the lower roll without doubling it down, or it doesn't make any sense to do the roll. Oh, and the other option, of course, is simply rolling down the $200 calls, which are 18, to the, let's say we roll them over to the, well, let's say we spend 30 bucks and go to the 140 calls in 2024. Well, what am I doing? I'm spending 30 bucks to go $10 lower in strike and buy a year. That's a real expensive way to do it. But then I say, okay, but what if I do that and sell for $30 the 180 calls? Then I'm in the 140, 180 spread and I spent nothing. All right, so that's all right. But again, it goes back to I'm only going to get my money back because I spent 45 bucks on those calls originally. Even though I'm spending nothing to adjust it, and I do get my 40, I get 40 of my 45 back, which is frankly a win considering we're at 18 now. I get 40 of my 45 back at 180. So that spread has some attraction. At least roll it and put ourselves in a better position and buy ourselves more time. At least do that if we're going to stay in the stock. But either way, the best thing to do is wait for guidance, wait to find out what's happening with Alibaba, wait to see what's happening with China Tech. But at the moment, Alibaba is an incredible bargain. All things being equal, if it wasn't for China interfering with stuff and people being nervous, it's a fantastic value right now. So that's, every position in your portfolio, that's what you've got to look at. Okay, it's like, what is my loss? What am I looking at? And that's the worst performing stock in our portfolio at the moment. So that's why we took a good look at that. Everything else is pretty much green. And by the way, that's also another point. That's why we can afford to be casual about it, because everything else is green, because this God damn it, look at this. Because the portfolio is up 300%, because it's up $1.5 million, then that puts this loss, this $50,000 losses in perspective. All right. Oh, and that goes for the puts too, because the 200 puts are 62.55. And now we go here and we look at the put side and we say, well, 62.55, that would be the 190 puts here in 2024. That's not a very good roll then, is it? So we'd have to roll to a lower strike. What would we roll to a lower strike? First of all, there's a lot of premium in 62.55 at 200. That would put you down at 137.50, right? We're not at 137.50. We're at 151. So there's a good chunk of premium here. 20% of this thing is still premium. Over 20% of this is still premium. So there's no reason to do anything about that. I'm not going to pay the premium to roll it, especially when the puts I want to roll them to have very little premium. The one, to spend no money, I have to roll to the 190 puts, and they have basically the same premium. So I'm not gaining enough to make it worth it. If I was going to roll it, I would roll it to these guys at a $45, and then we would take our, and then you figure it out and you say, let's see. I'm sorry. Okay, so we have 62.550. So 62.550 in obligations. And if we look at the available, that. Okay, so 62.550 in obligations. How many puts are we willing to have? Well, we're willing to buy 1,000 shares at 200. That was our original premise, right? So what about at 150? Well, at 150, we're going to get 33.50 apparently. And then there's 36, 39. So these seem to be the sweet spot. So let's say divided by 39, divided by $39, or 3,900 really, is 16. So there you go. So if I want to make an even roll here, we would do 16 of the 160 puts. So we're dropping $40 lower in strike, and we're buying 60% more actual stocks. But that brings us back down to here. But again, I need more information before I do that. I'm not in a hurry. The premium, it's got a lot of premium still in it. That premium is only going to wear out over time, no matter which way Alibaba goes. That premium will wear out over time a lot faster than the premium that's in this one. And I want more information before I decide. I don't necessarily, and again, I'm not sure I want to have 1,600 shares of Alibaba at, what did I say, 160. I'm not sure I want to have $256,000 worth of Alibaba because I'm not positive they won't go to 80. Because I don't know what's going on in China. And yes, we're already obligated for $200,000. So what's the difference, right? We're already obligated for $1,000 at $200. That's $200,000. So I'm only taking on an additional $56,000 in obligation. So it's not a big deal to do that roll. But we don't know what's going on. Therefore, we wait. And I know that frustrates a lot of people. Everybody says, oh, shouldn't we do this because of that? Shouldn't we do this for that? That's not why you make an adjustment. You make an adjustment because you see clearly the path. It's like football. I used to be a running back. And in football, you don't, you wait until you see that the field presents itself. In other words, there's a play, and you have a play, you have an idea in mind when you start that this is what I'm going to do. But then once the ball is hyped, okay, once the play starts, the field changes quickly, okay, because the other team had a play, and they're moving and they're doing something, and you're running, and you thought there was going to be one guy, now there's two guys, so you have to make an adjustment. But you don't make an adjustment, you don't change your play until you see clearly what the adjustment should be, until you clearly see how these guys are lining up. That's when you adjust the play. So you have to wait, and because we put something in motion with Alibaba, and we make adjustments, but we want to make adjustments. We know what we're thinking in our mind. If they do this, we'll do that. But we don't know where exactly the turn is going to be. We don't know how things are going to be set up, and we need more information. And if you need more information, you wait until the play resolves itself. That's the key to this whole thing. So you have to think of a portfolio as a live thing that's going to continue going, and there's no particular reason. If you don't know enough to change it, don't change it. Oh, the Fed. I forgot about the Fed. So wait, let's see. Fed. Futures. Let's see what the Fed did. Well, a little disappointment I smell. Do we have a Wall Street Journal? Do we have anything here? All right, let's go ahead and pick up the Fed. I know we're not going to get anything out of this, but we'll see what they changed. La-da-da, September. Oh, they got the projections, though. Those are fun. Let's see. Okay. With progress on vaccination, strong policy support, indicators of economic activity and employment have continued to strengthen. The sectors most adversely affected by the pandemic have improved. The rise in cases has slowed. What? But the rise in COVID-19 cases. Oh, I see. The rise in COVID-19 cases has slowed the recovery of sectors. Blah blah blah. Inflation is elevated. Transitory is still in there. Bullshit. Overall financial conditions remain accommodative, obviously, in part reflecting blah, blah, blah. Path of economy continues to depend on the course of virus. Progress on vaccination will continue to reduce the effects of public health, but the risks to economic outlook remain. Committee seeks to achieve blah, 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 with inflation persistently below. Committee will aim to achieve inflation moderately above, so inflation averages 2%, blah, blah, blah. The committee expects to maintain accommodative stance. The committee decided to keep the target rate at 0.25%. It'll be appropriate, blah, blah, blah. Inflation has risen 2%, so on track to exceed 2%. Oh, is it on track to moderately exceed 2%? They're finally admitting that it's over 2%. Last December, the committee indicated it would continue to increase its holdings treasury $80 billion per month and mortgage-backed securities by $40 billion per month until substantial further progress has been made. Since then, the economy has made progress toward these goals. If progress continues, the committee judges that a moderation will soon be warranted. Nope, no pullback, no changes. See, that's why I said earlier. Someone asked me why the market was going up, and I said it was probably leaked. So there you go. That's what I meant when I said that. So where are we? Nope. Stockburn asked, why all this buying ahead of the Fed? And I said, don't forget the Fed is having a 2-day meeting, started yesterday, and then the announcement. So I'm sure they leak all over the place, and I guess it's a very mild taper or maybe none at all at the moment. Keep in mind we had a bit lower inflation indicators recently, and labor and housing have cooled, as well as oil prices and all those excuses. So I said that an hour before the thing. And that's what all these excuses and everything are. That's what they're saying, exactly what I said. So I could have this meeting in 5 minutes. I didn't need to wait for them. But this is a big surprise. So they're keeping the qualitative, the easing the same. They're putting 80 a month into it, into more 40 billion a month of mortgage-backed securities and 80 billion of treasuries. So the Fed is buying $1 trillion worth of treasuries per year, and they are buying $500 billion worth of mortgage-backed securities. Now, if you think about that, there's no excuse, there's no reason for this. Why are they buying mortgage-backed securities? We don't have a housing crisis. We don't have a mortgage crisis. We don't have the same problems that we had in 2008. Yet they are handing $500 billion to the banks, taking every bad loan off their hands. This is nothing more than a get-rich-quick scheme for the banks. The banks get nothing but pristine mortgages. So in other words, all the risk that the banks are supposed to take as mortgage lenders has disappeared. And anytime they have a bad loan, they just give it to the Fed. Here you go, bad loan, bad loan, bad loan. Take it, take it, take it. It's ridiculous. So the banks do extremely well on their books, make unbelievable amounts of money. How much do they make? Well, they're collecting an extra $500 billion from the Fed. That's how much is being added to the banks. This is really crazy. So the longer they can find an excuse to keep doing this, the better, because the Fed is a banking organization. The Fed is not a government organization. The Fed is a banking organization. Their goal is to make the banks richer. That's what they're there for. And they get to use our money, taxpayer money, to do that. Since then, the economy has made progress towards these goals. If progress continues, the committee judges a moderation in the asset may soon be warranted, but hopefully not. These asset purchases help foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of credit to households and businesses. Aren't these lovely? Aren't they great? Does it really, though? Does it really? Have you talked to businesses about trying to get a loan and how hard it is? And the kind of qualifications they expect from people when they're getting a mortgage? They're not. It's not that accommodative, believe me. And if that's in the appropriate stance of monetary policy, the committee will continue to monitor. Blah blah blah. It's the same bullshit. So there you go. Big surprise. The Fed is keeping rates the same, and the Fed is doing whatever they're doing. Fed tees up taper, signal rate rises possibly next year. It wasn't going to be this year. Now it's back to next year. Oh, the economic crap, though. We forgot about that. And then it says U.S. stocks rise as Fed signals possible 2022 rate hike. This is then all interpreted, but as you can see, it's actually, it's exactly what they thought it would be. This is a sell on the news kind of thing. Oh, coming back a little bit. But there's nothing, but again, it's all spin. The thing happens, then they have the spin, then the people start talking, then Powell's going to talk now and spin it some more. But on the whole, we already had our rally. We had a pre-rally because they already knew what was going to happen. And that's where we are. So we're back at these levels. And again, like I said, though, 4,400 on the S&P. Now the dollar should come down. Ooh, what a weird thing. Dollar went up and down like crazy. So we don't know what the dollar is doing. That's interesting. And it caused the other currencies to spike too. How crazy. How about oil? What is oil doing? Oil staying strong, 72 bucks. Oh, so economically, let's see what the Fed thinks about the economy, if anything's changed there. PDF or HTML? Do we want HTML? Economic projections. This is probably, see if we can make this bigger. Control plus. Okay. So GDP, what is this telling us though? This is really crap. All right, I'm just taking it at face. I'm just thinking, I don't understand what has changed. Oh, June projection, there it is. I'm sorry, that's what I was looking for. How much did it change from June? So change in GDP. They have lowered their GDP projection from June to now from 7 to 5.9. That's pretty significant. The weird thing is, though, they then raised next year's projection and raised 2023's projection, but 2024 is back to like no growth, very little growth. Unemployment rate, basically the same. This is the most stunning one, though. It's like, look at this, 7 to 5.9. That's a big dip. That's almost a 20% drop in GDP, or in GDP growth, anyway. PCE inflation. In June, they predicted 3.4. Now they're predicting 4.2. That's significant. But then magically, it has no effect on next year, zero effect on the next year after that. So they are still considering this to be a blip, even though the blip is now 30% higher than it was last quarter. Core inflation, again, big 20. There's a 20% increase in here. Yet they don't think it's going to last. They are giving it a little bit more for next year, but it's jumped up significantly. And the Fed is talking in the statement. They're talking about 2%. This is not 2%. This is not close to 2%. They're supposed to be tapering. They're supposed to be raising rates when this happens. They're not. They're just letting it run away. And the Fed funds rate, now look at what happened here, though. This is interesting, too. The Fed fund rate was originally projected next year to be 0.1 and 0.6 a year after. They are now up significantly, 0.3 and 1. That's a big change, and nobody's talking about that. And what's this thing? Longer run, 2.5%. How are we going to go? Hang on. Well, I actually had that in the post this morning, so let's take a look at where we are. Okay, so how are we going to go with $30 trillion? That's 28 or almost 29 plus the $3 trillion deficit that's going to be added to it is 32. So how are we going to go from $32 trillion in debt and paying 0.1 at lending money or having a Fed funds rate of 0.1. So let's say right now we're paying like 32 trillion times 0.015. Let's say we're paying 1.5% now as an average rate. That's $480 billion a year in interest that we're paying now. Okay, now what happens if this goes from 0.1 to 2.5? What happens if this goes up 2%? Well, same 32 trillion in debt, although it'll be more by then, but let's say we pay 0.2%. Nope, sorry. 32,000 billion times 0.02. Let's say it goes to 2%. $640 billion. That doesn't sound right. $2%, 32. Yeah, okay. Then $640 billion a year. I mean, it's significant, becomes a significant amount of money, and that's only at 2% interest. If we are paying more than 2%, if we pay, once you hit 3%, 32,000 times 0.03%, you're paying $1 trillion a year in interest. Where's this money going to come from? I'm not sure if it set it up here. Does it have our annual interest? Nope. So that must be good. I think it's on there. National debt clock. I don't know what this will look like on your screen. Interest payment, U.S. total, blah, 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 blah. Bank interest, student loan, credit card holder. Oh, here it is, interest on debt. Currently 405, that's what I said, 1.5%. So currently $405 billion. Now, what happens if that goes from 405 Oh, I know what I did wrong. Okay, yeah, there you go. That's the problem, because it's not going from that to that. It's going from 405. I'm sorry, I didn't add it correctly. I said, what if it goes 2% higher, but it's 2% higher than 1.5, and I just said, what if it goes to 2%? So what if it goes to 3.5? That's the problem. Then you've got, instead of $405 billion of interest, you're going to be at $1 trillion of interest, $600 billion higher. That's just the interest. And discretionary spending of the government is only $1 trillion. You can't cut everything. You can't balance that, okay? And we're already running usually we're running $1 trillion deficit. We're running a $3 trillion deficit this year because of the $2 trillion stimulus, right? That's where you get $3 trillion from. The normal $1 trillion that we underfund our government by, the normal $1 trillion that we don't collect enough taxes for, plus $2 trillion stimulus so far. And now if they're going to pass another 3.5 trillion, another 1.1 trillion, what's that going to do to the deficit? We're going to be way over 30. We're going to be 32, 33, 34, next year 35 trillion, maybe more in debt. And then over that course of time, while that's happening, rates are going to go up, and we're going to have to pay $1 trillion a year in interest. From where? How? We are not doing a good job at all of addressing the situation. We are, we're just going full speed into disaster. I mean, we're really like a bankrupt like a family that's going bankrupt, and they just keep spending. They're just like, well, use the cards until they run out, because you can't fix it. You're going to go bankrupt. You're not going to be able to do anything about it. So just keep going until they close it. Like stores do this all the time, right? In restaurants, they keep running the store, keep selling the food, even though it's losing money, even though every meal you serve is another nail in the coffin, right? They don't change the restaurant. It becomes too late at a certain point. You look at that, what's that show? Gordon Ramsay goes around like supposedly saving restaurants. But if you actually follow up, and I do, because I'm that kind of person. But if you actually follow up on those shows and you look at the restaurants and look them up and find out what happened, almost every single one dies anyway. Which boggles my mind, because they spend a lot of money. Like the show puts in a lot of money, but I guess that's production costs. What else do you have? You have Gordon Ramsay and a couple of people, and instead of a set, they basically buy ovens and things for the restaurant. But maybe they take them back when they go bankrupt. Maybe they buy. If I was doing the show, I would do it, and I would put in the ovens and so on and so forth. But I would put it in such a way that I'd have a lien on it, that's a first priority lien, so that if they don't make some token payment over time, then we take it all back. So then I could use it for the next people who then we use it for the next show, the stuff we repossessed from the first show. But the point is, they go into these restaurants that are generally failing, right? And they're failing, so they have bad cash flow, they're losing money, whatever, blah, blah, blah. They come in and they change the menu, and they change the kitchen, and they fix everything and buy new appliances and so on and so forth. And they say, God bless. And the people, of course, are like, oh, wow, this is so fantastic. And because Gordon Ramsay is walking around town and telling everyone, come try this restaurant, we fix the menu, everybody goes to try the restaurant and fix the menu. So while he's leaving, after being there for a week, when he's leaving, everything seems great, right? Everything, people are coming in, it looks like they've got business. But the reason they don't do follow-up shows is because it's a disaster, because they haven't really fixed anything. You know, you have to sustain the traffic, you have to have an advertising model, a business model, you have to have a cost model, you have to rebuild cash flow, and they don't do any of that stuff. You know, they do talk about food costs sometimes, but you know, you've got to, you know, your restaurant has to work. And some restaurants work and some restaurants don't, as we all know. And the question is finding a sustainable model that's right for the community. And just doing a big splashy fix-up is not the answer. And they also don't renegotiate leases, which is something that would be obviously critical. You know, what's your major costs? Your major costs are going to be labor costs and rent costs. Those are your two major, and of course food costs. But I mean, you can't help that. You know, things have to be fixed properly, and otherwise you go bankrupt. That's what I was saying. So basically, you're going to go bankrupt anyway. So like Sears was like redecorating their stores as if that was going to fix anything. It just basically it soothes the investors, but it doesn't change anything that's happening. And that was all being done so that Eddie could ESL, what was it, ESL Investments? Where is this? That's still around, right? ESL? No, what happened to them? Unless I have the symbol wrong, maybe they took it private. So anyway, Eddie Lampert, he took all the best Sears properties, put them into this ESL investment, then they sold the properties off. He made billions of dollars while draining Sears and letting it go bankrupt. He made it for his other company, because his other company took over all the prime bankrupt Sears. Now, had he done that, he could do that under the cover of Sears constantly needing money and going bankrupt. So instead of buying Sears and being the villain and selling off all the good assets and keeping the money and blah, 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 he couldn't have done that as the CEO of Sears, because he has the responsibility as a shareholder of Sears. But instead, as the CEO of Sears, he then sells the distressed assets, and he sells the crown jewel assets off to another company, which he happens to own. That's all done with the full approval of the board, because they're like, well, we desperately need money and therefore this. But they desperately need money because he never fixed it. He never did anything to fix the company. And that's what America's doing right now. We're doing nothing to fix the company. We are bankrupting this country. We are going full steam ahead into a complete collapse. But the only good news is so is the rest of the world. And it's going to be very interesting to see what happens, because every country is doing this pretty much. And if every country is doing it, what's going to happen? Effectively, the monetary system is going to collapse, which is why people think Bitcoin is going to be a thing, because something's got to be a thing, because we're turning currency into a joke, and that's where this inflation is coming from. You know, when you can be 32 trillion dollars, 3 plus 29, when you be $32 trillion in debt and going or you're 28 trillion, 29 trillion debt, and you're going to go 3 trillion more in debt, and next year we're going to go, either next year or next quarter, depending on when they pass the stimulus bill, we're going to go another $3 trillion in debt, another 10% more in debt, that we have no possible way of paying back. Absolutely impossible. I mean, obviously, total federal tax revenue, $3.8 trillion. Income tax, 1.9. Payroll tax, 1.2. So of 3.8, let's say 2 and 1.3 is 3.3. So 3.3 is being paid by workers, income tax, payroll tax, okay? 300 million is being paid by corporations. So 1/10 of the taxes are being paid by corporations. 9/10 is being paid by the workers. Now, we need, all right, let's pretend COVID magically goes away and we don't need any more money for relief, and let's pretend there's not going to be any, we don't need to fix the climate, and we don't have to worry about global warming. So we don't have to go to a carbon neutral future. We're not going to spend $1 trillion a year that we need to spend to do that, because it's magically going to go away. And let's pretend it's going to magically go away, and because we don't spend any money to fix the environment or to stop or to reverse global warming, that we also don't suffer the conditions of global warming, like the weather catastrophes that we're having now will suddenly go away. Even if we fix everything where it is now, we still have $1 trillion annual deficit. So the only thing standing between us now in 2021 and $40 trillion in 2030 is we spend no additional money other than what our usual $1 trillion deficit, and everything magically gets better, and there are no consequences, and nothing needs to be fixed for the next 9 years. And if all that goes well, we'll only be $40 trillion in debt. So if we want to fix it on the revenue side, what do we have to do? Well, we have to increase this by 50% more tax. All right, either that has 50%, or that is still people paying taxes. So 50% more tax here, or we have to ask corporations to chip in 300% more money. They have it, but will they pay it? No. No. They will burn Washington to the ground. In fact, they tried to do it in January. They will burn Washington to the ground rather than be taxed. So it's going to fall on either we run up a deficit of 40, either we're going to be $40 trillion in debt. And again, if everything goes great, at the end of this decade, 9 years from now, we will be 40 trillion in debt. If everything goes perfectly and we spend no money to fix anything, not infrastructure, not anything, not a penny, we'll be $40 trillion in debt. Unless we increase individual taxes by 30%. And all that will do, it won't pay anything off, it will only slow the debt down. So that's choice number one. Choice number two, now, that's choice number one in a perfect world. Now, if we spend the $1 trillion a year we need to spend for infrastructure, if we spend the $1 trillion additional that we need to spend for energy infrastructure to get ourselves into a clean energy environment, if we do those things, we're going to be 50, it's basically 10 trillion no more. It's basically 10 trillion per decade. We'll be 50 trillion in debt. We'll be 60 trillion in debt. If we suffer the consequences of environmental catastrophes the way we have been, that's another hundreds of millions or more dollars, another trillion here, trillion there, whatever. But the big numbers are really, do we fight climate change for $1 trillion a year? Do we rebuild our infrastructure for $1 trillion a year? And we're supposed to do both. But those two things will put us up to $60 trillion in debt. We're going to be 40 trillion in debt no matter what we do. We could be 50, we could be 60. At 2% interest, $50 trillion means $1 trillion a year in interest right there. At 4% interest, $50 trillion is $2 trillion a year in interest alone. Completely unpayable. Economically impossible, mathematically impossible. Where would you get $2 trillion more out of these people? Cannot happen. And especially not with 2% long-term growth that the Fed is telling you. 2% long-run growth, 1.8% long-run growth. That is not going to grow you out of it. And there's half the decade gone already. So, you know, sorry, that bums you out. But anyway, this is just madness. It really is. We're being so unrealistic, and it just is crazy. This is literally a family about to be bankrupt going on a really expensive vacation because what may as well. And that's what this is. This is a very, very expensive vacation. And the Fed is spending $120 billion a month for us to feel like, you know, to basically to forestall the foreclosure on our debts. But like I said, the whole world is doing this. The only saving grace in this is that everybody's doing it. And if everybody's doing it, what's going to happen? Who's going to be the one who says, I'm pulling the plug on this thing? But the whole thing is just this giant fantasy, though. That's where it is now. That's why it's gotten this bad, is because nobody is willing to call bullshit, because everybody's bullshitting. So Europe, the ECB isn't going to call bullshit. The Bank of Japan isn't going to call bullshit. The Bank of China isn't going to call bullshit. Every economy in the world is doing this, but pretty much, there are certain economies, and there's a chart of that. You can see who's got the big debt, but there's small countries that don't have a deficit and aren't running budget negative, and frankly, they're kind of foolish because they could be, but you know they don't have the power, and of course they all suck on the teats of our outflows, so they're not going to really want to end the game either. They don't want to cut off the aid from the countries that are going into deficit spending. You know, we had that when Trump first came in. That was one of the first things he did, is he said, I'm cutting all this foreign aid. Why are we giving money to people? You know, so all the kind of countries that don't run a deficit are the kind of countries that don't have the wherewithal to run a deficit, and they need the aid mostly. You know, maybe some Arab countries, maybe Liechtenstein, you know, things like this. There's certain places that don't have massive national debt, but they're those kind of places, like small countries that nobody really cares about. All the major powers, massive deficits, unpayable amounts. You know, I mean, to any country, they're in proportion to us. We're bad. We're not the worst. Japan is the worst. Japan is twice as in debt as we are. They're pretty much 300% of their GDP in debt. They have a $5 trillion GDP. They have $13 trillion in debt. So it's beyond unpayable. At the moment, right now, 40% of the country's GDP, 40% of their collections, of their revenue collections, goes towards interest payments. 40%, and that's at 0% interest, basically. 40% of the government revenues that come in go towards paying off the interest on the debt they already have, and they're running a constant deficit. So what happens? Where is the end game to this? We'll see. But you know what? The U.S. can be $60 trillion in debt before we're even anywhere near as bad as Japan. And you know what? We will be. We'll be $60 trillion in debt in 10 years because we have to spend the money to fight climate change. Otherwise, we won't be here anyway. So I mean, we have to spend the money on infrastructure. We have to spend the money to fight climate change. We have to retool our energy system to be clean energy. Has to be done. And that's going to take us to 60 trillion bucks in debt. That'll be double our, that'll be at that point triple our GDP. And let's say our GDP grows 2% over 10 years. Let's say our GDP is now, let's be generous and say it gets to 30 trillion. So it'll still be 200% of our GDP will be debt. And if we grow our GDP to 30 trillion, that's a lot of inflation, right? That would be pretty much doubling in 10 years. Would be not doubling, 50% up in 10 years. It would be much more than 2% growth. It would be a much harder growth rate. And if we grow that fast, that means inflation is bigger, and that means that the rates would be higher, and that means that we have more money to spend on the on debt servicing. There's not, and I don't have a solution, which makes this depressing, because I don't have an answer for this, but I'm just saying the only thing that we have to look forward to is that everybody's doing it. Who's going to go first? Japan will go first. They'll be the canary in the coal mine. If when the jig is up in Japan, everybody's going to fall like dominoes. And I don't know what the escape is, but what I do know though is none of this market stuff. They're not taking any of this into account. This is all pretending that this can just go on forever. And it can't. So you got to be careful. That's why we don't have a lot of banking stocks. It's nothing imminent though. It's like, we're that slow boiling frog, right? It doesn't leap out of the pot because he doesn't realize it's getting hotter. That's what we are. We're the frog in the slow boiling water. We just let it keep happening. We know it's uncomfortable, but we aren't taking any action because we keep thinking it'll somehow get better. But how is it going to get better when we haven't even fixed what's wrong? And that's what I was bitching about today with the COVID too. Wait, is that today? Yeah, that's today. Oh, no, it wasn't here. It was later on. So the UN, the World Health people in the UN said stuff. Here. Biden made a speech at the UN. He said, we have to vaccinate the world. We can't do it this way. And this person, doctor, whoever the hell, at the World Health Organization, he said the country by country approach, the nationalistic approach, or the state by state approach that we have in this country is not going to get us out of this pandemic. You can't do this. We have not solved anything. We're just letting it go. We are the frog in the boiling water. We are literally not doing anything to save ourselves. We're not stopping this virus in our own country, let alone other countries. And how can you though? When you're this divided, how can you save yourselves? How can you do the proper thing? And why are we this divided? Russian hackers. Why are we unable to act? Because the internet has been used against us to divide this country and create a partisan divide that cannot be breached. So half the country believes that this is all bullshit and will not get vaccinated. Not half the country, but half the country half the country thinks that's okay. Maybe half of those people are getting vaccinated anyway, but it still leaves about 25% of this country unvaccinated. And that wouldn't happen if we forced them to vaccinate and we made rules that said you have to be vaccinated, but we won't do it. So unlike China, who had one death last month, we had 45,000 deaths last month. We have 1,500 people a day dying of COVID. We had 4 million infections last month. More than 1% of our population got COVID last month. That's a rate of 10% per year, even though we've gotten vaccinated. Because just like the flu, it changes all the time, and it mutates, and it evolves, and it evolves faster than we can fully vaccinate against it. And it happens because we don't fully stamp it out. Very, very likely we are past the point of being able to do anything about that. At this point, we probably can't fix it. So we are going to have to learn to live with COVID. And governors like DeSantis and governors and the governor in Texas, they think that the best thing to do is let everybody get COVID, and that way the strong will survive, which is herd immunity. That's what herd immunity is. The strong will survive. And that's really what we did in 1918 more than anything else. We didn't wipe it out. We didn't wipe out the flu in 1918. We learned to live with it. And we developed our own immunities, and the people who are strongest survive. The problem is now we don't really do it that way. The strong don't necessarily survive. The people who get medical care survive. The rich survive, not necessarily the people who are the healthiest and have natural immunities and so on and so forth. So we're not really going to make the population stronger over time. And if the virus is always around and we don't make the population stronger, what eventually is going to happen is a mutated strain of the virus will break through again and infect everybody again. So we are not doing that. Silver is way up. Yes, I said that yesterday. So that got me off the topic. So who said that? Tom. So yeah, Tom says silver's way up. Yeah, silver, remember we held on to silver. So yesterday we talked about that. And gold, here is my logic in that. Where's the metal? Yeah. So anyway, so yesterday we got out of gold because gold had made a run up to 1775, and I said, well, look, since we had silver and gold had gone up a lot, but silver was still down here yesterday, because today. Silver was still down here, but gold had a much better day, but it was at 1775, and I said, let's take the gold off the table and let silver ride. I would have liked to have let gold ride and hope to see 1800 again, but we have the silver trade, so there's still 2 longs on silver. And honestly, should take half off at 23, should take 1 off at 23, but we did good on gold. Now we can set a stop, certainly set a stop at 2280 because we came in below that. So certainly set a stop at 2280 at this point, so that if it goes below that line, we'll get out and have a nice profit in addition to the gold profit. But if at this point, if we let it ride, because if you look on the longer term chart, silver was at 28. So this could be, I couldn't even do the math. I think that's 5,000 per dollar with silver. So it'd be $25,000 if it gets up to 28 again. So I mean, I'd rather risk it going back to 2280. Wait, hourly. Let's see hourly. Okay. So I'd rather risk it going to 2280 and not making the extra money and just give it a chance to go up. But hopefully it can have a nice run and get back here, even 25. It's $5,000 per dollar. So let's give it a little bit of a chance, I think. So that's where we are with that one. And again, it's just like the long-term portfolio. Because we made money on other positions, we can be a little bit looser about this one. It's like, and we're not going to lose money. We're locking in a profit here, but hopefully we don't see that line again. But as it goes higher, I'm probably going to get even, probably get looser again. I mean, once it's over 23, probably set the stop around 23. And then if it goes to 24, I'll set it at 23.50, that kind of thing. But I'm going to give it a wide berth to give it a chance to have a nice gain and come back. But you can see silver is like these massive moves. Here's a 1-day loss from 24.80, 50 cents. So these are basically 50-cent 1-day moves. So you gotta, if you want to ride it out, you've got to give yourself a pretty wide berth. So not here, of course, but once you're able to lock in profits, then you can say, okay, let's let it run. But again, only if gold shows us that it can keep running. If gold shows us it's going to go up to 18, great. If gold flakes out over here, then forget it. Then we'll take the profits. So Brian, oh, I see. So then the dollar popped up and silver came back down, blah, blah, blah. Somebody's watching silver very closely, huh? What is a dollar doing? Oh, the freaking dollar is crazy. Whoa, look at that. Seeing that too. So when you see the, silver's down because the dollar went up, then they say, well, okay, let's give it a chance. But the dollar, of course, could be much stronger. The dollar, well, I mean, not all year. but the dollar can come up to 93.50, and then it wouldn't be surprising. But honestly, it's been toppy there for quite a while, so you could expect that it won't really go much higher. So you definitely would rather give silver a chance at this point from that. But on the grand scheme of things, if you look on the longer term, this could happen. You know, this is how charts get made. The reverse of this can go the other way, just like here, boom, down, and then we have the reverse of it going the other way, but it took a lot longer. So this failure of 1 year reversed over 2 years, and then it came back down in 1 year. And if it reverses over 2 years, you're still going to end up with a pretty strong dollar. But again, that goes to all the relative stuff, right? We are running a massive deficit, but so are other countries. So it's a question of who's flooding the world with the most money relatively, and who's running a bigger deficit. You know, Japan's problem is they're a relatively small currency in the grand scheme of things. So when they have to run a huge deficit, they're drastically increasing the supply of yen in the world and devaluing their currency. And that then causes inflation in a stagnant economy, stagflation. But Japan has another problem, which is their demographics, because Japan has a very old population, then they're creating not enough babies. So they're in population decline, aging and declining population, total disaster economically. They have no choice but to just keep printing money, and I don't know what the plan is. There is no plan. Yeah, and they're also extremely anti-immigrant in Japan. They're very they really, Japan's for Japanese people basically, and so they don't want people coming in, and they're not having babies. They don't want people coming in, and everybody's old. So I don't know what the end game is there, but we're gonna begin to, we'll see the beginning of it. We're gonna see the beginning of the end in Japan in 20 years. It will be very interesting. You know, and this country foolishly has kicked out immigrants, where we should be welcoming young people who want to join the workforce and take cheap jobs and contribute to Social Security and so on and so forth. We should be telling them, come on in, not kicking everybody out. So we're doing a lot of things wrong. Put it that way. We are doing several things incorrectly, and that's definitely one of them. All right, let's wrap this thing up. Thank you everybody for coming, and you know, hopefully we'll have some more interesting stuff next week. We're going to be until the first week of the month next month, so we're going to have non-farm payrolls on Friday, and I think, wait, is Friday the 1st? Yeah, Friday's the 1st, so we'll have non-farm payrolls on the Friday, and then it's earnings season. And then we'll start finding out, and then we'll figure out, then we'll know in our portfolio, because we've moved the portfolio to like 80% cash. 1.7 out of 2 is actually 85% cash. So we have 85% cash in this portfolio. All right, but of course, you know, since we sell a lot of puts, that cash has obligations on it, but the cash is there, and we're flexible. And if we kill all and the point being though, if we kill all the positions to get the total value of $2 million, if we kill everything, we'll end up with $1.7 million basically. If we kill every position, we'll end up with $1.7 million in cash, maybe some value from the positions we kill. Also, we have the short-term portfolio hedging it. But if we have $1.7 million in cash, there's a lot of stuff we can do with that to make money. That's the point of getting to cash. That's the point of being flexible in your portfolios. We can shut these down one by one by one and just get the hell out and sit on the sidelines if the market starts collapsing. And in the short-term portfolio, whoa, down 60% again. That's weird. We were down 45% yesterday, 28,000. We lost all of yesterday's gains. Wow. Not yesterday, but this week's. So we reversed all the gains. We're back to being down 70%. So we have only $78,000 value left in the short-term portfolio. So we have a lot of cash, but it's, in fact, we have more cash than the portfolio is worth. But shutting that down would be painful. But these are our hedges. And yesterday, or not yesterday, Monday we made $35,000 in the short-term portfolio. So and it offset all the losses in the long-term portfolio, and that's the point, is to protect the long-term portfolio. If this gets any worse, though, we're going to have to take 100,000 from the long-term portfolio, put it in the short-term portfolio to buffer up our hedges. And that, again, that's why I wanted to go to cash. I don't want to have to protect all these positions. It's expensive in this kind of market to protect $2 million worth of positions. So, this is, if it's a topping market, $35,000 changes everything very quickly. $35,000 where we were was 110 or something like that, and the portfolio was down 40% instead of being down 60%. And then another couple of days like that, and you're back to even, right? And then you've got $200,000 in this portfolio, and the long-term portfolio would lose. In fact, the long-term portfolio lost less money than the short-term portfolio gained. So we're right now too bearish. We're way too bearish for a big rally. And so we'll have to see how it plays out. And that goes back to what I was saying. Same thing with Alibaba. Got to wait for more information. We have to see what earnings look like. We have to see what guidance looks like for the rest of the year before we start shifting anything. And we already made our reflexive adjustments in the short-term portfolio, anticipating more of a sell-off. And if we don't get more of a sell-off, we either have to buy more longs or cover these shorts. And we can't do any of that until we know what's happening. All right, so tune in next week. Hopefully we'll start getting clues, but over the next 3 weeks, we'll see plenty of earnings. We'll get a great idea of what's going on for the rest of the year. All right, thanks everybody for coming. I appreciate it, and we'll do it again next week. Bertie says, why is the market rallying on the Fed news of tapering in November? I don't think they really said they're going to taper in November. They said they'll taper eventually, and a possible rate hike in 2022 because those things were baked in already, and the Fed has taken the mildest possible course towards doing them. So it's basically just more free money, and we're rallying. But it's going to be a short-term rally. It's not news. It's no big deal, and it doesn't affect anything. All right, thanks, guys. Take care.